The very first step we must do is to have a first look at the high time frame direction, usually on the hourly chart, the 1 hour or the 4 hour. So before getting into the deep analysis, we look at this market and ask, what is the trend on this high time frame? Now it shouldn't be hard to notice how this market is currently running on a downtrend. So first step is kind of checked, but we need to make sure you properly understand the fundamentals of the downtrend. On a downtrend structure, the market forms swing points externally of lower highs and lower lows, and that is what creates this footprint on the chart, where you see that it's constantly going down. And this downside action is not random. It has some logic and theory. On downtrends, the impulse happens to the downside. The impulse is an aggressive move where bearish candles are usually larger than bullish candles, or there are a lot more candles closing bearish rather than bullish. This is seen more easily when the market is approaching the highs. For example, look here, a bearish candle much larger than the recent ones from its left. Also here where we got a chain of bearish candles, basically one after another. On the next highs again, the bearish candle is larger than the bullish ones. That's what I mean when I say this theory has some logic. But back to the important part, because the impulse indicates that there might be a supply on the last high where the market often pulls back into this level so it can form the swing lower high. And it's from this supply where we can capitalize and take opportunity with a potential sell-short setup, hopefully taking the market into bearish continuation. That would be below the previous swing low. When that break happens, that's a break of structure. Basically, the market left the past price action of a lower high and lower low, and then it enters into a new structure. And on downtrends, the price action is just repeated lower highs and lower lows, so the higher probability is that after a break of the past low, a pullback to the upside should happen, similar to what happened earlier. It's exactly the same theory, because this upside pullback will end many times on a supply from the last highs. This supply was formed from the previous bearish impulse, and what we can do is to capitalize once again from potentially looking to sell down from the new supply, basically from the new lower high, into targeting the past low, expecting an upcoming lower low formation. And now we just apply it on the actual chart. So if we look on the swing points, they are formed from a push to the upside, followed with another push, but this time to the downside. This downside movement breaks below the previous low. When the break has been confirmed, that's when we can confidently say, this was a low, a high, then a lower low. So we have a bearish swing formation. Remember that after a break of structure on a downtrend, so after the market breaks down the last low, that's when a pullback to the upside will happen a lot of times. The destination of the upside pullback is on a supply zone. The logic of a rejection from the supply is that the market must end the pullback on a lower high, else if it forms a higher high by breaking above the previous swing high, the downtrend in that case invalidates and we meet a trend reversal. So during downtrends, the swing points of the highs must always be lower than the last highs, and this rejection from the supply should target the recently formed past lows into forming a new swing lower low. Now again, when there is a bearish break of structure, the market pulls back to the upside. This pullback should end on a supply so it can end with a lower high formation from where it rejects back down. So far, it's respecting the theory on the last price action. Now from here, two things can happen. The downtrend can invalidate. This happens if the push to the downside ends above the last low, and then the last high is also broken to the upside. This is what counter-trend traders are looking for. However, so far there is no bullish sign of a trend reversal. So most would probably choose to trade with the trend since it's more simple, and the scenario of trading with the trend would be an expectation of the market holding this bearish push to the downside, eventually breaking down the past low into forming a new lower low, basically exactly the same as it already did before. Now if we look at the last lower high and question why the high rejected back down from this point, by asking this question we basically reverse engineer the theory. Well, it probably rejected down from a supply. To find that supply, we look at the left of the last lower high, being the previous lower high, and there we should be able to identify a supply, which by the way, the supply itself is the last bullish candle, right before the market started to push to the downside, which it would be around this candle, and more specific the entire candle including the wicks. And that's exactly where the last lower high ended right before it started to drop back down. If this drop continues and manages to break below the last low, after the break we should be expecting some kind of pullback to the upside, which is then rejected from a supply into breaking the past low. So we need to identify where the upcoming lower high will probably end. And as I said many times in this video, and just like we saw on many examples in this chart, The lower high usually ends up on a supply, so we need to identify the last supply available, which should be found on the last lower high, and more specifically on the last bullish candle, before the downside impulse started. Now to put the theory into practice, we zoom into the last lower high and make sure to mark the supply. Now you can see it even better, and we'll be looking for a sell setup down from this supply, with the stop loss above the last lower high, and take profit below the last low. These two placements, of course, have logic behind them. This stop loss is saying that we don't expect a higher high on downtrends, so that would be the safest level, where if the market actually does form the higher high and the trend reverses into an uptrend, we get out with a small loss instead of potentially a bigger one. And this placement of the take profit is saying that you expect the downtrend to keep going, just like it did multiple times on this market recently, basically expecting downtrend continuation. We hit the supply right now. Shortly after, the market starts another impulse to the downside, so it reacts bearish from the supply, and this bearish reaction keeps holding until eventually the take profit closes the position. So as complicated as it might sound, all we really did is to just follow the downtrend fundamentals of repeated lower highs, identifying a supply, resistance, or whatever bearish structure you like that's usually found on the highs. And we just look to sell down from those highs into breaking the past low. Now on another market, and this time we learn about a concept that's called the internal price action. The internal price action are the mini trends or smaller trends that are formed inside the higher trend. For example, the straight up movement formed from a swing low into a swing high. It's made of an uptrend on the lower time frames. This lower time frame uptrend can also be seen on the higher time frame as well. If we look at the structural levels, we see how it's forming higher highs and higher lows. But eventually, the internal uptrend reverses into an internal downtrend. The internal uptrend breaks when the market pulls back to the upside but fails to break the last internal high, and instead it breaks the previous low to the downside. So it forms the first lower high and lower low, but this on the internal levels, because on the external or higher time frame price action, the market was still running on an uptrend at this current time. It's just that when we get the break of the previous internal low, the trend reverses on the lower time frames. And the first break of the internal low is called an internal bearish market structure shift. And we see how right after, the market then repeated the same internal formations of lower highs coupled with lower lows, which is holding a downtrend. So this entire price action that we see on this chart can be represented in the following way. Having an initial uptrend that later breaks down into a downtrend. The downtrend begins the moment the market breaks the previous higher low and it turns it into a lower low. After that lower low, we see how the next highs always ended lower than the past highs, and the same for the lows. Each of the next lows were lower than the past lows. So it's been holding a downtrend formation. Now we've spoke mainly about the internal price action on this market, but we also have the external price action. If we look at the external or higher time frame movements, we have a push to the upside from a swing low into forming a swing high, then a breakdown to the downside into forming another swing low. So it forms a swing lower low. Now after a break of the past low, we expect a pullback. Externally, a pullback during a downtrend is seen as an internal uptrend, which is exactly what we're having on these last movements. That's where we now need to focus, because internally here, we see how we went from a downtrend into an uptrend. Basically, we broke above the last internal high, having formed the first internal higher high, and the structural formations of uptrends are higher highs, that then are followed with higher lows. So we basically expect some kind of pullback to the downside. But the important and crucial part of this pullback is that it needs to end above the last low, so it can form the higher low, respecting the formations of the uptrend. Now if you remember, on downtrends, the lower highs end on a supply zone, and it's from that supply where we look to sell the market down. Now on uptrends, the higher low ends on a demand zone, so it works in the exact opposite way. So from the lowest point, the market pushed to the upside and broke the last high, reversing the internal downtrend into an internal uptrend. Now the market is currently pulling back down. This pullback should often happen on a demand zone, this marking a higher low, so it can hold the uptrend that it just started. Now if we translate this into the chart, we expect an internal pullback into a demand, so it can form the higher low. This gives a buy setup opportunity, so we can hopefully take the market into internal higher highs. So now we can test it out with the buy position, the entry on the demand, stop loss below the low. The logic behind this placement is that if the uptrend invalidates and the market actually keeps going down with a break of the past low, well, in that scenario, we get out with the smallest loss we can take, instead of possibly taking a bigger loss if we hold the position for longer. So the logic of the stop loss is to lose as little as possible in the scenario where we are wrong about the market's direction. And for the take profit, we might have multiple options. The simplest one is right above the recent internal high. Depending on the risk-reward ratio, you can decide if you would want to get out on the first target or risk one of the levels from above for a higher ratio. For example, above the next internal high. At the second one, in this specific case, you get a decently high ratio. Some are more risk-seeking and want more out of a position, especially if the market analysis took quite a long time, and they usually target the upper levels, the one that's very close to the swing high, or even above the swing high. Now the thing is that in order to win such a setup, you must accept losing a lot in a row before eventually actually hitting a win. Most won't take it psychologically. What can help in enforcing such a setup is to do a quick analysis of the market once again. So just a slight zoom out is needed to see how this market was quite bearish for some time, so obviously a downtrending market. On downtrends, we have two possible outcomes from this swing low. The market can slowly climb up and eventually break above the last swing high. The problem with this scenario is that you're trying to predict the exact moment of high time frame reversal. So having the take profit above the swing highs is a placement more suited for counter-trend traders. These traders, as I said, usually lose a lot of setups before eventually winning something like this with a huge risk reward. Now, trend traders usually look to target one of the internal levels, so they don't actually target a trend reversal of the high time frame, but rather they buy this pullback and hopefully leave with a win before the market could reverse back down, because that's also a possibility, and actually is the more likely scenario that the downtrend continues on the high time frame. So we just keep the take profit at this 2.5 ratio, right above the second internal level, since it brings a good enough risk reward, while also not putting ourselves in a risky situation. Now the market pulls back, the pullback hits into the demand, and the market printing a very bullish reaction out of the demand, breaking straight to the upside above the last internal high, which closes the position on the take profit target. Now structurally based on the price action, after a break of the last high, we expect a pullback that is actually happening right now. This pullback needs to form a higher low, which should be followed with a higher high, essentially breaking above the high. And this keeps happening one more time. But one thing we must be careful of is that the market is approaching the swing high, and there could be a possibility that we get a rejection from a supply from the high time frame, from an external supply. You can use the concepts that I have in the program that you can find on the link in the description of this video. They come in good help in increasing your probability of knowing if we might get a reversal or a downtrend continuation. Also, I highly suggest watching the recent videos, and we'll see you on the next one.